Hello, everyone. Welcome to the stock-specific class here for Thursday, November the 4th. We talked about on Tuesday the market getting into a little bit of an overbought condition. It's still in that condition, but it seems to be just, from everything I'm looking at, it looks like we could have a little bit of a near-term pullback. But as far as the larger context, we're still not in extreme ranges yet, so I don't expect a big correction anytime soon. So, a lot of what's overbought is there's a few of the leadership stocks that are really driving this. The small caps have started to pick up, but the market breadth, as we're going to see here in just a second, is just not. It's not there yet. So in other words, there's only a handful of stocks that are kind of overbought in extreme levels right now. And usually you're going to see a transition into other companies or more participation before you start to see a larger correction. Now, again, all we talk about is probabilities. The market can always do things that are unexpected and will do things that are unexpected, because if we could perfectly predict what's going to happen, then you don't have a marketplace. I mean, the whole reason why what drives the market is uncertainty, and is the fact that we have to make decisions based on not knowing exactly what will happen. But again, the best you can do is to follow the probabilities, and you're going to be on the right side of things most of the time. So, could something come out of nowhere and cause a 10% correction in the market over the next 3 or 4 days? That's entirely possible. But from everything I'm seeing, there's still some room to run. If we look at well, first of all, if we look at this right here, you still have sentiment above momentum, above breadth, which is an indication of a kind of a tired market. Now, again, that could be a indication that maybe we're getting close to a correction, but it's not suggesting that the market is. It can't have room to run. I mean, usually you start to see these move into extreme levels. Look at momentum. See, momentum, it's about to go into an extreme range, but not quite there yet. And then really what we've focused on a lot over the last few updates is the breadth, the market breadth. It took forever just to get out of the trending range. Now we're in the high range, but we're nowhere near extreme. So again, there's not a lot of participation. There's becoming more participation. That's why we're seeing that indicator start moving to the right. But there's, and I'm going to show you something else that also kind of shows that there's still room to run, and there's still we will still need to see more participation from the market before we expect a larger correction. I'll show you that here in just a second. But sentiment's been high, and it remains high. Just really no fear from the market that anything bad's going to happen. And so now again, when we start to see all three of those get into that extreme range, especially the right side of the extreme range, then we have to really get defensive and prepare for maybe a much bigger correction. Now, if we look at look at the buy-sell ratios, again, we're not in any sort of extreme range here. And when we look at the buy-sell ratios of the entire market, we're only at like a little over 2.5 to 1. This sentiment indicator is close to getting to that extreme range, but it's not quite there yet. But then look at the indexes here. This is something I've told you. You don't have to check on it every time you log in, but you want to check on it occasionally. But this shows you the buy-sell ratios of each of the individual indexes. And remember, when you start to get extreme levels is when you start to get double digits. The higher ones right now, well, we do have double digits on the transports. The Dow transports are 14 to 1 ratio. They're getting a little bit extreme, but you look at all these others, especially, if you want a really broad one, if you look at the Russell 2000, we're not even 5-to-1 ratio. Now this can change very quickly because this is based on stocks moving from hold to buy. The longer you have the uptrend, you probably have a lot of. We've had an uptrend here for a while, particularly in the Russell 2000. We'll look at that chart here in a second, but so you probably have a lot of stocks that are at hold that are very close to going to buys, and so this can change very quickly. You get a few more days of a run, and suddenly you're at 10-to-1. That can happen pretty quickly, but again, we're not seeing it yet here play out with these numbers. So, and this is kind of weird because the market kind of has a feel right now that it's really overextended and it's getting kind of crazy, but yet underneath the surface, it's suggesting that it could keep going. Now that tells me though, when we are a little overextended on the charts, in fact, let's go look at the charts here. It could tell me we could get a little bit of relief where it pulls back or moves sideways for a few days, something to kind of alleviate that near-term overbought condition. But again, nothing that's really pointing to a major pullback. Here's the SP. We're close to getting into the extreme range. We're not quite there yet. A very compact trading day today. Now, I am seeing a situation where the SPY is up and the VIX is up. And when I told you this, whenever you see that, you want to pay attention. What that means is that the institutional traders are buying stocks, but they're also buying protective puts, meaning they're not quite trusting the trend. Okay. Now, it makes total sense to me why they would be doing that, because they're seeing the same thing I'm seeing. I'm not some unique person that sees things in the market that nobody else sees. Anyone that knows how to read a chart and knows how to read market indicators are feeling the exact same way I am. So it would make sense that they can see that the trend could still go higher. It's not extreme yet, but it is a little overextended in the short term. So why not buy a little bit of protection just in case? And that would cause that VIX to move up. So in this context here, this is why the VIX indicator is really kind of tough to read, because it's not a clear red light, green light type indicator. It combines. Well, if you understand what it's telling you, it makes sense. What it's telling you, the kind of my layman's term definition of the VIX is it tells you the level of freaking out by the institutional investors. Okay, but you have to understand it's the big money traders that are creating the movement of the VIX, because the average trader doesn't necessarily buy a lot of protective puts for their positions. Those big institutional traders do. Now, again, I don't want to get too much into this because I could spend the whole time talking about the VIX, but the reason is because when you and I need to sell, if we have 100 shares of a stock and it looks like it's going to go down and we need to sell it, we can sell it and sell all 100 shares at pretty much the same price. It's not that 100 shares is not going to drive the price down any further because it's such a small amount in the context of how many shares are available on that stock. A big institutional trader has thousands of shares, 100,000 shares of the stock. If they try to sell all 100,000 shares of the stock, they are going to cause the price to drop dramatically. And in other words, they're creating the lower prices that they're trying to get out of by trying to sell too much too soon. Okay. So they can't get out immediately. So they've got to buy those protective puts that'll go up in value when the stock goes down in value to hedge against it. So they can sell as fast as they need to and have it not wipe them out. That's why they call it protective puts, kind of insurance. Okay. So once you understand that when you're looking at the VIX, it's telling you kind of what the institutional trader is thinking. that's what helps me to conclude just what I told you, that they see that there's still some upside, so they're buying, but they're a little bit cautious because of the near-term overbought condition, that they're hedging a little bit. Okay, that's actually a good sign in my opinion in this context, because when you're this close to a major market top, what you would want to see is the opposite. As far as knowing that you're at the top, you'd want to see these institutional traders saying, I don't care how overbought this market is, we're going higher. There's no need to hedge at all, because why spend that money when I know for sure we're going higher? And that's when you get to that crazy bullishness type situation. When it feels safe to get in, it usually isn't, right? So when you get to that condition, that's when the warning lights go on and you're like, okay, you got to get out of this thing because it's about to crash. And so the fact that they're hedging a little bit right now is actually a good sign. It's telling you that there is still some, the market is still kind of climbing that wall of worry, another stock market term that's used all the time. So, but in the near term though, again, we got a real compact trading day today after a big run up this week. If you look at the Dow is actually down, and it has a bearish inside day right here. We've had a move up right here. You have the big candle yesterday, and then today we're inside of it, and we're in the opposite direction. So yesterday it was up. Today it's down. Now it's down from where it opened. So here's where it opened right here. It's trading lower than where it opened, but it's still inside of yesterday's price movement. Okay, it's not the strongest bearish reversal, but that's a bearish type pattern there, at least in the near term. And none of the candlestick patterns are long-term predictors. They're very short-term predictors, but then if you combine them with other things, the fact that we're at the top of this big run up here and we're getting a bearish inside day could tell you that maybe we open a little bit lower tomorrow. But we're not in the extreme range here, so it could shake it off. We could open a little bit lower or even be down tomorrow and the next week take off again. So it is kind of playing along with what I've been talking about. That in the near term, maybe we pull back a little bit from here, but we should continue the uptrend. The Qs are the strongest movers, a big candle, and it's moving into the extreme reversal risk range right here. So we need to keep an eye on that. And then the Russell has a bearish reversal candle, even though it's up. It was showing it was up. It's now showing it's down a little bit. But it opened up here, ran all the way up here, and then came all the way back down. Now it's trading lower than where it opened. So that's a bearish reversal candle, and you're at the far right side of the extreme reversal risk range. Pretty good chance that we see a little bit of a pullback in the Russell over the next couple days or so. Now, one thing to point out that I don't think happened Tuesday in the update. Maybe it did. No, because it happened yesterday. Yesterday we finally, the Russell broke out of a long sideways range that it's been in. And it finally broke out. Now, broke out in a big way yesterday, and then today we're getting a little bit of a bearish reversal. So maybe it comes back, and what used to be the ceiling up here now becomes the floor, pulls back to this area right here, and then maybe takes off again. So that we could see something like that happen. That would definitely move that extreme reversal risk off, maybe back into the buy range, or at least to the left side of the extreme range. But again, it doesn't have to. It could shake today's move off and keep going higher. But again, from a probability standpoint, when I see that, there's a pretty good chance it pulls back a little bit in the near term. And it doesn't have to pull all the way back to that breakout area. Here's the breakout area right here. It doesn't have to necessarily pull all the way back to here. It could just pull back a little bit. Now, another thing I've been kind of keeping an eye on too is the bond market. Again, I'm spending a little bit more time on this, on kind of market conditions here before we get into specific stocks, just because I don't have a lot of specific stocks I'd be wanting to get into today, just because of that kind of near-term overbought state. I think we could pull back a little bit. get a little bit better entry point. But but I think this stuff is important. Typically, the bond market and the stock market move in the opposite directions. Not all the time, but typically they do. And the reason why they typically do is because a lot of times those big institutional traders use the bond market as a safety play. Okay, when you and I feel like the market's going to go down, we just sell out of our positions and we keep our money in our brokerage account. And most cases, your brokerage account, when you're in cash in your brokerage account, it's in a money market fund. So technically you're earning some interest on it, but especially nowadays, the interest is pretty much nothing. But it just sits kind of in that cash in your brokerage account. Well, the big institutional traders can't just sit in cash. They've got to always be producing some sort of return for their clients. And so when they're fearful that the market, obviously the best way for them to make a return is in the stock market. That's your best chance to get those high percentage returns. A stock that's going to move up 10% for the year or 20% for the year, or that's going to pay a big, a 7% dividend or something that you're going to get a high probability of capturing that dividend. You're going to get better returns in the stock market. But when they're fearful that the market's going to drop, they come out of the stock market, and then they're not going to just sit there in cash. They got to get some returns. So they typically go into the bond market, where again, the returns are not big at all. They're not that big, but they're safer returns, right? So they kind of park their money in the bond market for a while to get at least some return on that money while they're waiting to get back into the stock market. And so a lot of times what you'll see is when the market starts selling off, the bond market will start going up, and it's usually because that's what's going on. You're seeing the institutional traders come out of the stock market and into bonds for that protection. Then when the market starts to go up, you'll see the opposite. See the money come out of the bond market into the stock market. Now, this isn't the only dynamic of the bond market. Let me make that clear, because otherwise it would always be that inverse relationship. You'd never have it moving in the same direction. But the problem I see right now with the bond market also moving a bit higher here, and we talked about this on Tuesday, where you've got higher highs, higher lows. It's acting like it still wants to go higher. We did have a little bit of a bearish reversal yesterday, but it's reversed it again today. So, but the trouble is if the bond market's going up, that means money is flowing into the bond market, which is money that isn't going into stocks. So it helps explain when you see that the bond market has been up a lot over the last year with the stock market up. It helps explain why there's been that disparity in market breadth, why only a few stocks are going up and the rest are lagging, because there's what that tells me is these big institutional traders are really they're really playing it safe. They're keeping the majority of their money in the bond market, and they're just trading. They're just getting into the high quality stocks, just a few stocks that they really trust out there. Now, again, that tells me that there's money on the sidelines that can still come into the market. That's another reason why I think this market could still go higher. But I want to start seeing that in the bond market. I want to start seeing the bond market start going down. If I can start seeing the bond market go down, the market is starting to go up and start to really take off, then I know what's going on. And we're seeing we see the market breadth really taking off. That tells me we're in kind of the final push. That tells me that they're now feel safe enough to get everything out of the bond market, not everything, but the majority of their money out of the bond market into the stocks. They're chasing. They're not afraid that the market's going to drop, and then that's when it gets crushed, and that's when everyone gets hurt, is when that happens. But again, I'm watching this pretty carefully here, because as long as this is the bond market is still moving higher, it's less fuel to be able to drive the stock market higher. And so at least that's what, like I said, the bond market is there's a lot of other factors going on there, but that's just one of the other little clues that I'm kind of watching and keeping an eye on to see if it kind of aligns with everything else that I'm kind of seeing with the market conditions. One other thing to watch is that look at the chip stocks, the SMH. Remember, this is kind of a leading indicator of the NASDAQ 100. Both are new all-time highs, but you've got the chip stocks really taking off lately, and so that's something to keep an eye on too. If you start to see the chip stocks break down and start dropping, they probably could pull back a little bit because it's the far right side of that extreme reversal risk. But if they really start selling off, then that would be a warning sign that we could see a big market correction coming too. So that's something to watch. The Dow Transports, you compare this with the Dow Industrials. The Dow Industrials have already broken out to new all-time highs. The transports are very close, and when you're this close, typically you're going to break out. And so again, this tells me that there's probably more room for this trend to run. There's really not a reason to believe that in the longer term, or longer term meaning the next couple months or so, that we couldn't see a continuation of this. Couldn't see it continue to move higher. Now, once it breaks out, and especially if it breaks out, and well, it's already at getting close to that extreme reversal risk. But if it breaks out, we get to that far right side of the extreme reversal risk, and everything else is getting extreme. Yeah, again, then we'd have to be concerned. So those are just a few things that I'm kind of keeping an eye on and watching. Bottom line, though, is that I probably don't want to be getting too aggressive here. In fact, with the portfolio, I know I'm still down a little bit from where it started, but I don't think I'm going to add. I really don't want to add anything right here. We have a few stocks in there that are getting to kind of extreme levels that I might take profits in here pretty soon, or tighten up stops. But I'm going to shift a little bit, not completely to cash, but I want to have fewer positions, at least here in the near term, because there is a little bit of a near term possibility we get a little bit of a pullback in the market because of some of those in that extreme range there. So just keep that in mind. I'm still going to go over some stocks today, but I don't think I'm going to be adding anything into the portfolio. Let's go into the sectors here. Under oil's still leading. And so the problem is sometimes there's a lot of these that we're either already in or we don't want to get I don't want to have the whole portfolio be oil stocks necessarily, but this FTSI right here, 98 strength rank, and you're getting you have a little bit of a cup with handle type formation here. Now, it really would need to break out to really be, kind of a true cup with handle. But again, the potential there, if it breaks out, is that you take the top of the bowl to the bottom of the bowl, and then you can project that upward, that same distance upward. I can't even do it here on the screen. And that gives you kind of an expectation of how far it can go out of that range. It doesn't always go exactly that far, but it's kind of a rule of thumb. And something doesn't become a rule of thumb if it happens rarely. It usually happens enough times where you kind of expect that. So there's potential there for a pretty good move, but you might want to wait for it to break out. And it's at a hold signal right now anyway. Let me switch this to signals. And it could go to a buy signal before it breaks out, but I'd probably wait for it to break out. Another one in the oil sector is this TGA 97 strength rank, TransGlobe Energy Corporation. And this looks like it could be kind of completing an ABC correction, wave A, wave B, wave C. Probably it could go down a little bit further, which is why I'm just kind of putting it on the radar right now to kind of keep an eye on. We'd want to wait for it to go back to a buy signal anyway. But here's the break. Here's the last break. So here's the bowl-shaped move. And this is what I just told you. Here's kind of a cup. It didn't really have a handle here, but you have a cup formation here. To take the distance from the top of the cup to the bottom of the cup, it puts you about right here. And like it went a little bit higher than that, but it did kind of go that distance when it broke out. That's why we use that type of, and that's why I like to see these types of patterns when they break out, because they give you a high probability that you could get a move, the big move. And they don't always happen immediately either. You don't always go straight up from there. But it looks like we could be pulling back to that breakout area, which is why I think we still have a little bit more of a pullback here in the stock. But then if it can pull back in this area and hold it, go back to a buy signal, that would be one you'd want to keep an eye on, TGA. We go into computer and technology. This NLST, Netlist, 98 strength rank. Oh, this is never mind. This is a OTC stock. It's not on an exchange, so I do like that pattern though. But this is one that it's too small. I wouldn't really want to be messing with it. Sorry about that. I usually check that, but I didn't. I missed that one on that one. Business services. I like this RCMT 96 strength rank. This big run up right here. That's kind of, this looks corrective. It's kind of pulled back down. And then it looks like it's starting to, almost starting to get kind of that bowl-shaped move here. Where some of my favorite trades, I like to get in on stocks that look like they're forming these bowls. So when it looks like it's forming a bowl, I like to get in, and I like to trade. When I get enough confirmation, it looks like it's going up again. I like to trade the move from there to the breakout area. I like to trade that move there. And then sometimes when it gets to that breakout area, it'll move sideways. That's where you get the handle, the cup with handle formation. So usually I don't like to be in it in case it moves sideways. I don't want to just sit there and have it move sideways for 2 months or something. And then I like to buy the breakout because it has that potential to move up about the same distance as the top of the bowl, the bottom of the bowl. So if you're wondering when I pull up these charts, if you're wondering if they have any sort of a look like this or like this, you know immediately why I like it. And sometimes it doesn't have the bowl. Sometimes it's just simply that ABC correction like that. And I like to get into those as well, but kind of the same thing. I like to trade it up to here, and I like to trade breakouts. But again, this looks like a higher low right here. Now it needs to really go to a higher high, which probably would take place if it goes back to a buy signal. So we're going to we'll put this in the watch list. We'll keep an eye on it. Let me go ahead and do that. Put it in the watch list here. And I'll put it on an alert to let me know when it goes from hold to buy. Now another, I was in aerospace all the way down here. There was one that I saw that I liked, but I actually already went over. I might have gone over this last week even. But this EH up here, 91 strength rank. Again, it looks. I'm watching for. It's kind of this big pullback right here. It looks like you have a little bit of a double bottom right here. Looks like it could be starting to move back up. It needs to go to a higher high. You got a little bit of an inverse or upside down head and shoulders pattern right here. I'd like to see it break out above that area right there. But I already have that in the watch list, which means if I saw it a second time, didn't realize it was in the watch list, I liked it, that means it's doubly good because I liked it a second time going through the list there. So now there's also another aerospace one that's down a little bit further as far as the strength rank, but it's a little bit more of a well-known one, which is Raytheon Technologies. It's a 61 strength rank, but as you can see, a lot of stocks in this sector have lower strength ranks. Again, I've talked about this before, that typically we're looking for a 98 strength rank, but some sectors they just don't have, in the hold section, they just typically don't have high strength ranks. And so sometimes that can be a little bit of a relative thing. The 61 is still pretty low, but the fact that it's a larger company though too, a lot of the larger Dow type companies have lower strength ranks, but they're also you don't have to worry about those companies going out of business tomorrow either, so that there's a little bit of a trade-off there sometimes. But I liked here you can see it's pulled back here, but if you back out a little bit, look at a little bit bigger context here. Again, you have this big run up right here, and then you've got this kind of consolidation. You had a slightly higher low right here. You had a slightly higher high right here. We seem to kind of pull back to around that breakout area here. It's kind of have this pullback, about a 50% retracement of that move up. If this can go back to a buy signal, get back above that breakout area, I like this. And I like it for another reason too, which is that I've been reading a lot of, remember this is a little bit more of it's a defensive contractor, a lot of military contracts, things like that. I've been hearing a lot of, reading a lot of news stories about particularly China really getting aggressive with their military growth, and that the U.S. is got to kind of make sure they keep that superiority. They've got to keep building, keep getting better as far as the defense stuff. And so again, I don't typically buy something just off of the stories or opinions or anything like that, but the chart seems to be kind of backing that up, that it's coming out of a consolidation area. If there is, now Democrats don't typically spend a lot in defense, so you could make the argument that it's not you don't have the right political party to drive that. But then again, we got the midterm elections next year. If Republicans take control of the House and Senate, maybe that puts a little bit more potential for spending in defense. But anyway, again, this is why I stick to charts. I know charts. I'm not real great on fundamentals or any other way to trade, trading news or things like that. But I like the pattern there, and but it does need to get back up above that breakout area. But this is one, even though it had a lower strength rank, I thought I'd just throw it in there. Just as one to kind of keep an eye on if you're looking for maybe a larger company that has that potential to go a little bit higher. All right, going to the portfolio here. As I mentioned before, I don't think I'm going to do anything except for maybe tighten up some stops. We'll look at the individual charts here in a second. Still down about $3,500 or so. But that could change very quickly. We've seen some of these that we've been waiting for breakouts, and they just haven't happened yet. But you can see the ones that do break out, how fast they can move, which is why we like to try to get in ahead of those breakouts. But SBOW, this is a oil play. Oil's down a little bit today, so it's not surprising that some of the oil stocks are lagging a little bit. But you had this breakout right here. It's kind of pulled back to that breakout, waiting for it to take off again. go to the next one here. I, K, and X, same thing. Again, this one's been kind of consolidating for a long time. And this is typically what I try to avoid. I don't like to be sitting in something, and we have been sitting in this for a while with it going nowhere. Because we got in, we had this little breakout right here, and then it came back, and it was starting to move back up, and it went to a buy signal. This is why sometimes I say you might want to wait for the breakout. Now there's two sides to this. I say a lot of times right here, you say you might want to wait for the breakout, because then you know it's not likely to do this where it stays sideways for another month. But sometimes, though, if you wait for the breakout, you get a huge move when it finally breaks out. You don't want to chase it, because sometimes it'll break out and then pull back and retest the breakout. So that's the double-edged sword there, is like, do I get in before it breaks out to try to capture it? If it does break out, capture that big move. Or the risk is that it could still move sideways and you're sitting on, you have dead money there for another month or so. Or do you wait for the breakout, like I said, and sometimes it'll break out, barely break out, then you get in and you can still capture the move when it breaks out. But you're always kind of weighing that. And if you've been following this for a while, you've seen where I decided to wait for the breakout. I missed the move. It took off. And there's other times I try to get in before the breakout, and we're sitting in stocks forever because they haven't broken back out yet. But eventually this thing should break out, and if it does, then we should be able to profit from that, from our patience, so to speak. TTI, again, this one's starting to move. This is another oil stock. So again, it's not surprising it's down a little bit today, but it's pretty close to breaking out again. Again, it had the breakout through here, kind of came back, retested. Looks like it's about to break out again. You can see again this whole bowl-shaped move right here. I'm trying to trade this up into this area here if I can. IRIX finally did break out. Again, this is another one that we were waiting on forever, but this is where your patience can kind of pay off. I was thinking it was going to break out in this area right here. Got in a little bit before it. It stayed sideways for a while, and then it broke out, and it's really been moving. Now the danger here is that we're at the extreme reversal risk, far right side of that extreme reversal risk. Take a quick look at the longer term chart. Now this shows it possibly can go a little bit higher before it bumps into this resistance area right here. Again, you have a little bit of this bowl-shaped move right there. So I think the way I'm going to manage this is I'll instead of using a stop, I'll just, one of the short-term exit techniques we can use is I could wait for a close below the low of the previous day. Now, obviously, this is a move higher today, but if in the next, let's say tomorrow, it reverses and it closes below today's low, the key there is you'd want it to close below the low, not trade below the low, but close below the low. So this is a decision I'd probably make in the last 10, 15 minutes of the market day. If it really looks like it's going to close below the low of the previous day, go ahead and take profits on it. Now, again, this isn't always the best strategy. I did this on Tesla, and we did make a nice profit on Tesla. Actually, I didn't do it on. I did it on the bearish reversal candle. Where was it? It might have been right here. I just had a bearish reversal candle, and I think I got out, or I can't remember which. I have to look at the date on that, but part of the problem was it was going into earnings. I didn't want to take we had a big profit. It was overbought. It was in that extreme reversal risk range. And again, it might not have been here. It might have been here. I have to go back and look at the date. But anyway, I didn't want to risk it through earnings, and then it took off after earnings, and man, I could have made a lot more money. We definitely wouldn't be underwater in the portfolio if I hadn't taken that quicker profit. But again, you roll the dice with earning announcements because it could have easily been all the way down here, and we could have had a big loss in the portfolio because it gapped all the way down the next day. So, you know, we can't trade in hindsight, but I just wanted to show you that sometimes when you take that shorter term type stop type play, or you know, take your profits, sometimes that's the danger, is that it could continue to run, and you might miss out so on a bigger move. But I'll wait on I'll watch this one. Like I said, there's still a little bit more upside potential there, even though it is an extreme reversal risk. But if it does close below the low of the previous day, there's a stronger chance it pulls back a little bit further. We could always get back in too. That's another thing to always remember. I didn't really get a chance to get back into Tesla because it just took off again. I didn't want to chase it, but I'm usually not afraid to take those profits, knowing that either there's another trade out there I can get into, or I could get back into that same trade if I felt like I wanted to get back in again. TELL. Go back to signals here. This one's just starting to break out again. It broke out yesterday, kind of came back, and it's testing that breakout. This is also another oil stock, so it's not surprising it's down a little bit today. But this one is, again, looking like it's on the right side of that bull, reaching higher highs, higher lows, still acting like an uptrend. Let's continue to expect it to move higher. I think that was an oil stock. Yeah. ORMP, some medical products stock. It's getting in that extreme reversal risk there. Down a little bit yesterday. Kind of pulled back to that breakout area there. Broke out. Came back to it. Up a little bit today. We'll hang on to that one. I might tighten up the stop. I might move it just below that breakout area there, but I kind of want to see if this can move up a little bit higher there. So I'm still giving a little bit of room to run, because it can still kind of dip below it a little bit before still going higher. But I probably need to make a stop adjustment on this pretty soon to make sure we can lock in some of the gains there from that breakout. AR, another oil. We got a lot of oil stocks, which is why I didn't want to add any more. But here's your consolidation right here, where it looked like it was starting to break out today. It opened up here, but it's traded back down. But again, oil's down a little bit today, so that's not surprising. But there's still that potential for this thing to break out and run. CPE, another oil stock. Now this, so here you have your cup pattern right here. This is looking kind of like the handle. You get a little bit of consolidation right here. I had a big run up where it's looking like it was about to break out. Again, oil a little bit weaker today. It might take a little bit more time for this to break out, but again, that's the potential. We're waiting for a lot of these to kind of break out. So even though I'm down a little bit in the portfolio, again, it wouldn't take much if these stocks start breaking out, particularly with as many oil stocks we have. We still see oil go on another run, and we're going to get positive pretty quick. So I'm not too concerned yet about that. ASAN, internet software, again, very similar, where we broke out. We came back and retested the breakout area there. We opened a little bit lower today, but we have a little bit of a bullish reversal candle right at that breakout area. So we opened down here, and we're trading up here. And again, if you can't see that very clearly with the signals, you can switch it over to candlesticks. And why am I not switching to, hold on here. Sorry, my Traders Pro kind of froze up a little bit there. Just give me a second. Just scroll down to it real quick. All right. So here's the candlestick version of it. So this is ASAN. So we had the breakout, and you can see because it's gray, it means that it's trading higher than where it opened. So it opened. I know it opened down here, and it's closing higher. But here's where it closed yesterday. So it opened lower, and it's trying to regain that. If it's red, it means it opened up here and it's trading. It closed down here. It would close lower than where it opened. So the fact that it opened lower and it held right there at that breakout area that's starting to move up, that's a good sign. That it's kind of holding that. What used to be the ceiling is now the floor, so to speak. And BLNK, we're getting an extreme reversal risk on this. But again, you have this long decline, and now it looks like we're moving up the other side. Broke out to a higher high, have a higher low, the buy signal, and it kind of went up a little bit a few days ago, and then it came back down, and it's trading about where we got in. So we're kind of at break even right now. Open this area, holds right here. You have a little bit of that previous resistance right there. It could be a little bit of support, and then hope it can continue to move higher, hopefully it continues to move up the right side of that bowl. That's it. I do have about $9,500 in cash. I have enough to get into another trade, but I think I'm going to sit with this right now, just because of the conditions. I don't want to. I actually would like to be able to get out of a few of these, especially some of these trades that are really overextended. Take the profits on them, build a little bit of cash in case we pull back a little bit. Then we've got some cash to get back into some other trades. So, all right, that's all I have for today. Hopefully that was helpful, and we'll see you on Tuesday for the next market update. Bye, everyone.